The economic world is a very dynamic place. No one could accurately figure out what could happen overnight. Financial experts, based on their extensive knowledge and vast experience, can predict the nature of the market, but not all experts are always right. But there are very few financial gurus who can actually predict where the market is heading. Today, we're going to present interesting information which might be helpful to everyone, and this insight is about index funds. Who doesn't know about Michael Burry? If you've been following the financial markets, you must know that Michael Burry is a very seasoned financial investor with a keen observation on the market, and majority of his forecasts appear to be true. This time, Burry is saying that the famous market tracking index fund is in a bubble which is going to burst soon. As per his quote on Twitter, Burry explained that the difference between the present conditions and the dot-com crash of 2000 is the passive investing bubble that's been increasing consistently in the last 10 years. But is it really possible that a market tracking index fund could result in the downfall of the stock market? Well, we're here to decipher this riddle for you. When a person purchases a market tracking index fund, he's actually buying a stock that's representative of the diversification of the whole market. SPY is the biggest index fund in the world. This is an S&P 500 index fund. So when a person purchases SPY fund, it represents that the person owns a very small part in the largest 500 companies in the United States. The key point here is that when a person purchases the market, he'll be getting the same return as the market over a period of time, which is quite good at approximately 10% per annum. Owing to the great historical return per annum, along with being simple and easy to implement, passive investing has become quite popular in the past few years. As per a study from Bloomberg Intelligence, each company in the S&P 500 had more than 20% of shares through passive investment. It's interesting to note that passive structures held around 3.3% of the market, while in 2022, that number has increased to 20.5%. The increase in the number poses a question whether this passive investment being so dominant is a good thing or not. For Michael Burry, this is actually a point of concern. This isn't the first time that Burry has talked about the passive income bubble. Around 2 years ago in 2019, in an email interview with Bloomberg, he mentioned that price discovery has been eliminated from the equity markets due to passive investments, as these lack the security level analysis that's essential for actual price discovery. To put it in simple words, as the popularity of passive incomes is going to increase with time, the greater the number of shares of big companies will be held, and the reason for holding these is not the inclination of investors towards the company, but just because these companies are in the index. The result of the situation is the increased inflation of share prices. Shares are not being purchased based on the performance of the company, but because they're included in the right index, and since the price increases not because of the performance, but due to some other factors, the bubble appears. So the question is this: is the bubble dangerous enough that it could bring down the entire market? The answer to this isn't clear, and one needs to understand the behavior of stock prices in order to understand this. The share price fluctuates depending on the principle of demand and supply. So if there's a lot of demand for a certain stock, but only a handful of investors who want to sell it, the price of the stock will increase, while on the other hand, if there's a huge amount of shares to be sold, but there are not many investors, then obviously the stock price will decline. Every stock has an average trading volume, which is the amount of shares transacted every day. The trading volume doesn't affect the share price unless there's a huge disturbance in the market, such as if the market is going to crash and the investors are offering a lot of shares, then for sure the price of the stock will dip very quickly. The price for such a stock will be decided by the most desperate person who's going to sell the share first. This is exactly what Burry is predicting as per his tweet, in which he says that all theaters are overcrowded and the only way out is to trample each other. Burry, through his tweet, has indicated an all stock market example about everyday trading volume. The example states that a person goes to a cinema in which there are 100 people, and the only way to get out of the cinema is to have someone take your place, which is okay in normal conditions, as there would always be a person who will come to see the movie and take your place. But if the theater catches fire, all of the 100 people would run to get out of the cinema, and no one would want to enter. This is what Burry is fearing. He's of the view that if the conditions are going to get worse, passive investors will start leaving the market, resorting back to cash, and if everyone will be doing this out of worry, then the stock prices will fall, and this is the most common with isolated businesses. But when passive investors who own little portion of everything start leaving the market altogether, all stock prices will come crashing down. All the stocks that are in the index will have the same results. But one thing is to be kept in mind that no matter how much trading activity occurs in the passive funds, it doesn't make up a huge amount of trading volume in the companies that are included in the index. This is because the majority of the trading of ETF shares occurs in the secondary markets, which means that passive investors are trading the shares. Let's take an example of Vanguard from 3 years ago, which depicts the percentage of ETF trading on either secondary market or which in real life, the volume of trading of underlying securities. It was revealed that the majority of time, the trading was conducted on secondary markets, which means that mostly trading volume of the ETF didn't come into contact with the actual stock positions making up the ETF. But what would happen if the demand for the ETF is really high or there's an increase in selling happening altogether? In such cases, no new ET units are made or destroyed, and this results in trading in the underlying stocks. As per a study by BlackRock in 2017, a case about Apple was presented in which it was identified that in July of the same year, in which huge inflows to ETFs occurred, around $65.9 billion worth of Apple stocks were traded, while around 331 ETFs around the world held global stocks, but 95% of the trading volume was not due to ETF flows. This shows that though ETFs are a major stakeholder of the market in the last few years, they don't have a significant effect on the volume of trading of underlying securities that are held by these. But Burry is expecting a major crash in the market in the coming few years, and it's possible that he has a solid reason about this prediction, as in a stock market crash due to the panic, crazy selling cycles start to pop up, and a decline in the share prices can create frenzy among the investors to sell, which ultimately increases the selling volume, resulting in further declining of the share prices and creates a negative loop and can decrease the stock price really quick. So Burry is saying that if there's a real panic movement in the market in which the market tracking ETFs under stress are sold in huge amounts, there's a high possibility that the ETF selling could increase the decline of stock prices, and the most vulnerable stocks to the situation are less traded stocks which are in great number in these indexes. In the Russell 2000 index in 2019, he said that the majority of the shares are those that are traded in lower volume and have low value. The S&P 500 includes the biggest stocks of the world, but more than half of those are traded below $150 million. Trillions of dollars in assets around the world are linked to these stocks. The fire in the theater is increasing, but the exit door is the same.